Hey guys, welcome back to my financial focus. In this video, I'm going to be doing a stock analysis of Shopify, which as we can see, their share price recently declined from an all-time high of about $1,600 per share to $650 per share. So in this video, I'm just going to look at their financial statements in their annual report to try to figure out why that might have happened and also to figure out if this current decline in their share price presents some sort of a buying opportunity for investors in the stock market right now. So thanks in advance for leaving a like, and let's get right into the video. So for those watching this video who don't know, Shopify's whole business model is they're essentially an e-commerce platform that allows different entrepreneurs to sell products to customers online. And their two main revenue streams are made up, as we can see from this income statement, by their subscription solutions and their merchant solutions. And so for their subscription solutions, the way they make money is in order for someone to sign up and actually sell products on Shopify, they pay for a monthly subscription, and they can also upgrade to different subscription plans as their business grows and scales to size. And so Shopify basically collects monthly reoccurring revenue streams from the subscription revenue. And then from their merchant solutions, this is primarily comprised of payment processing fees as well as foreign currency conversion fees. And we can see that this makes up most of their total revenues from their two main operating segments. So for 2021, we can see that their revenues increased from about $2.9 billion to $4.6 billion. And then their gross profit increased from about $1.5 billion to $2.4 billion. We can see that their operating expenses during 2021 also increased pretty substantially from about $1.4 billion to $2.2 billion. And then we can also see this massive line item in 2021, which is a net unrealized gain on equity and other investments. And this primarily came from an investment that they had in this business right here called Affirm, which went public in 2021. And so they recorded on their balance sheet in the retained earnings section, and for their income statement in 2021, they transferred this unrealized gain to their balance sheet and recorded it at this amount based on what the share price was as of December 31st, which was at about $100 per share. And so they just recorded that on their income statement as an unrealized gain and then included it into their net income. And that's what primarily resulted in the massive increase in net income that they had from $319 million to $2.9 billion. But without this line item, if we were to subtract this from their net income amount, we would see that for 2021, their net income actually declined from about $300 million to about $100 million. And so that's something to keep in mind, especially when we're looking at like why this share price decline could have potentially happened after their earnings were released and after other analysts probably got a good look at their financial statements. This might have been one of the things that contributed to the decline in their share price. And something else that I think is pretty interesting is if we look at their price to earnings ratio, it says that it's 28. Now, obviously, if we're calculating a price to earnings ratio and in the denominator of this equation, we're including like once in a blue moon line items like this net unrealized gain on equity in the earnings amount for the price to earnings ratio, then that's obviously going to increase the denominator, and that's going to make the price to earnings ratio a lot lower than it possibly could potentially be, because if we don't include that number in the denominator, this price to earnings ratio is going to be a lot larger. And so Shopify, even at the $650 price that it is right now, declining from an all-time high of $1,600 per share, it could still potentially be overvalued if we are including these like once in a blue moon income revenue streams that might not occur again in 2022. And so the last financial statement that I want to look at is the cash flow statement. And because this statement is only dealing with cash, we can see that Shopify, when they reported this, they actually subtracted that net realized gain on equity from their estimations of the cash inflows and outflows from their business operations. And so this gives us a better look at how much cash was actually produced by their operations. And we can see that despite the fact that they subtracted this net unrealized gain, they still experienced an increase in their overall operating activities from about $424 or $424 million to $500 million in 2021. And we can see that they increased their investments from about $1.9 billion to $2.3 billion in 2021. And then also their cash flows from financing activities was, as we can see right here, about an inflow of about $1.6 billion, which is down from $3.5 billion, mainly because they didn't raise as much money from proceeds from public equity offerings as well as from convertible senior notes. And so their cash and cash equivalents at the end of the year actually decreased by about $200 million from $2.7 billion to $2.5 billion. And so I think that one thing that we could do, which I tend to do in a lot of my videos to figure out what the intrinsic value per share of a business is do a discounted cash flow analysis. And I went ahead and did one already right here using a couple of growth rates and balance sheet estimates that I got from Yahoo Finance and TradingView. And so according to Yahoo Finance, the growth rate for Shopify is probably estimated to be about 38% per year for the next 5 years, compounded annually. And so for the next 5 years after that, I was just a little bit conservative and cut that growth rate in half. And we can see that this is the free cash flow that's projected per year for the next 10 years based on these growth rates and based on the amount of cash that's already on the business. And then I discounted these values back by 10% per year because I want to try to aim to get a 10% return per year, at least when I'm looking at investment. And so for me, if the present value of the future cash flows based on this discount rate of 10% isn't worth it, then it won't be a good investment from my perspective. And we can determine if it's worth it or not by looking at the intrinsic value per share. Right here, we see that it says that based on these values and based on the fact that they currently have about 113 million shares outstanding, that the intrinsic value per share is estimated to be about $279 per share. And so compared to the current share price, even though the share price has fallen from an all-time high of $1,600 to $650, it still seems like Shopify could potentially be overvalued. And if I scroll down right here, we see that analysts don't really seem to know what to make of Shopify. We have like 50% buy holds and like a 2% sell right here. And also their earnings per share was lower than what was actually estimated when they reported it a few days ago. So based on these amounts, I'm not too sure where Shopify stands from being a good buying opportunity from a value investing perspective. I mean, I think a lot of people looking at this might think that Shopify presents a good buying opportunity since they're trading at less than they were at around May 1st, 2020, like around that date, which is like 2 years ago almost. So based on this, it could be a good buying opportunity, but also based on what we saw from the financial statements with this massive line item here that they're including in net income, which could be altering the price to earnings ratio, it could also still potentially be overvalued. But I'd love to know what everyone watching this video thinks about Shopify from a value investing perspective. Let me know in the comments down below. Leave a like on the video, subscribe to the channel, and I'll see everybody in the next one.